Thank you very much, Mr. Speaker. We have, sir, before us not one but two orders relating to the ceilings that are prescribed on the level of borrowing, domestic and external, respectively, that we can contract as the state of Guyana. The first, sir, is the public loan increasing of limit order 2021, order number 2 of 2021. And the second is the external loans increasing of limit order 2021, number 3 of 2021. Because the subject matter of these two orders is so closely related, I will, sir, offer remarks that could be considered directly relevant to both orders in my current presentation, with the intention that once the first is put to the House, that the second can be proceeded therewith immediately thereafter. The public loan increasing of limit order 2021 is an order that is made under the Public Loan Act, which is an act that prescribes the limit of public loans that can be contracted in Guyana, that is to say, the level of domestic debt that can be undertaken or assumed by the state. And we are seeking, sir, in this order, to increase the limit from its current level, which is $150 billion, to $500 billion. The second, sir, relates to the External Loans Act, and in that case, the current limit is $400 billion, and we are seeking to revise that limit to $650 billion. Mr. Speaker, the background to these two orders is as follows. We have enshrined in law successive parliaments limits that apply to the level of debt that can be contracted, with the aim and objective of ensuring that we do not contract excessive or unsustainable levels of debt. And from time to time over history, this limit, or these limits rather, have been revised. They've been revised to accommodate the prevailing economic realities of the country. Mr. Speaker, when we assumed office in August of 2020, we embarked on an effort to take stock of the state of the public finances. In doing so, one of the first and most stark realities, one of the first and most striking realities that we discovered was that the state had accumulated, or the government had accumulated, beyond the domestic debt that had been publicly reported, had accumulated a number of other liabilities and indebtedness, including an overdraft which at the time exceeded $90 billion. An overdraft, a net overdraft, I should say, at the central bank, and I will come back to why I emphasize that, a net overdraft, which means that when you take the aggregate of all government bank accounts and you offset the overdraft by positive balances that might exist in other bank accounts, other government bank accounts, a net overdraft that was approaching $100 billion. If you were, in fact, sir, not to net off the overdraft with the positive balances, the overdraft was considerably higher, in excess of $100 billion. If you take account, sir, of other obligations, including commitments that had been entered into, payments that had been issued but that had not yet been processed, contracts and other undertakings that had been assumed, the accumulated indebtedness was considerably higher. If you add on top of that contingent liabilities that had been assumed by the state, that is to say, borrowing contracted by other entities, but for which the state was either explicitly or implicitly exposed, whether by way of a government guarantee or otherwise, that accumulated to additional billions of dollars. To give you one example, sir, the now well-known NISIL bonds that were issued for the purposes of raising financing ostensibly for Gaisuco, and I say ostensibly because we are yet to discover what in fact that financing was actually used for. Those bonds accumulated to $30 billion, of which $17 billion had been drawn down, for which there is limited or no capacity to repay, and in relation to which the state has a binding obligation to honor as a result of a guarantee, an unconditional and binding guarantee that was given by the Treasury. That's another $17 billion. If you add all of those, sir, if in fact the overdraft had not been accumulated at the central bank, but instead had been financed by domestic borrowing as would have been required by the normal course of things, if in fact the government guarantee had not been issued, but instead the debt had been contracted as government debt, if this device of an off-balance sheet borrowing transaction, shifting it off of the government balance sheet, but supporting it with a government guarantee, making it a contingent liability, if that device had not been used, but instead the liability had been contracted directly by the state, we would have seen, sir, we would have seen the ceiling of $150 billion, which was the ceiling in force at the time that ceiling would have been breached. One can only speculate, sir. One can only speculate as to why these transactions were treated and classified in the manner that they were. One can only speculate why the decision was taken to shift this borrowing off of the balance sheet of the state. What we do know is that it did have the effect of avoiding being counted within the ceiling. One can only speculate why, instead of contracting borrowing to finance the deficit, the state took the opportunity of simply accumulating an unauthorized overdraft at the central bank, which incidentally the country was cautioned against, and I will come back to that. But had these transactions been reflected in the way that good practice would have required them to be reflected, the ceiling would have been reached. On top of that, sir, we came into government discovering that vast liabilities had been accumulated, artificially causing the fiscal deficit to have the appearance of being lower than it actually was. To give you an example, instead of the government honoring its electricity bills to GPL, which would have widened the fiscal deficit and necessitated additional domestic borrowing or additional borrowing to finance that deficit, the Treasury took instead the reckless course of action of not honoring their electricity obligations, and at the time that the APNU-AFC government demitted office, owed GPL a staggering $12 billion, with obvious and direct consequences for liquidity at that company, with obvious and immediate consequences to that company's ability to meet its own obligations, including critical maintenance of its plant and equipment, its generating plant in particular, its transmission lines, with immediate and direct consequences for the company's ability to invest in its capital expansion program. The debt was simply accumulated, the state simply refused to pay GPL, damaging severely the company's financial position, while at the same time avoiding an accurate reflection of the fiscal deficit and avoiding the incurrence of an additional $12 billion of debt. And the list goes on. As the days go by, sir, we have unearthed more and more and additional layers upon layers of debt, of other liabilities, of other obligations, of other commitments undertaken by the state, all summing to a completely parlous state of the public finance. We therefore have, first of all, sir, to regularize that matter. It would be recalled that we came to this National Assembly not so long ago seeking approval of an amount of $6 billion to start to pay off the government's debt to GPL. That, sir, is an immediate call on the public treasury. It has immediate impact on the fiscal deficit, and it has immediate impact on the borrowing requirements of the state. But the company is cash-strapped. They have supplied the electricity to a wide range of state agencies, and they should quite rightly and correctly be paid. We have now the matter of this staggering overdraft, which, like I said, exceeded $100 billion when one takes into account all of the obligations, not just the bank balance at the time that we assumed on, but all of the other obligations. And when one adjusts for the fact that you really should be looking at the gross overdraft and not the net overdraft after offsetting the positive balances in other government bank accounts. That matter, sir, now needs to be regularized. In addition to that, we have, of course, outlined a development agenda that is intended to bring relief to the people of Guyana who have been suffering for the past 5 years the consequences of bad economic policy, unconscionable economic policy even, adjustments to punitive taxes. This Honorable House will recall that Budget 2020 immediately moved to lift those punitive and unconscionable taxes, many of the punitive and unconscionable taxes that were placed on the backs of the people of Guyana, to implement interventions aimed at restarting the economy, which was reflecting the toll, both of policies of the past 5 years, of the events that transpired in Guyana between March and August of 2020, and also, of course, the devastation of COVID-19. All of these interventions, sir, have to be implemented. as a matter of immediate urgency. And on top of that, you know, sir, that we have committed to the people of Guyana an agenda for transformation of our country as outlined in our manifesto, which constitutes our contract with the people of Guyana, and on the basis of which we were elected to office. Those interventions will need to be financed, for which purposes, unavoidably, new borrowing will have to be contracted. It is, sir, against that background that we have moved and are now proposing to increase the ceilings that apply to both the domestic and external debt ceiling. I might add, sir, that these ceilings were last adjusted almost 30 years ago. In the case of the domestic debt ceiling, it was last adjusted in 1994. In the case of the external debt ceiling, it was last adjusted in 1991. And if I might, sir, point out that given our government's strong track record as it relates to sound and prudent fiscal and debt management, a track record which we would always jealously guard, we have ensured that we have set the ceilings at levels that would ensure continued fiscal and debt sustainability, given that we worked so hard to achieve fiscal and debt sustainability during our previous time in office. This House, sir, would recall that when we assumed office in 1992, Guyana's public debt exceeded our gross domestic product, or the size of the economy, many times over. Our debt, our public debt, as a percentage of GDP, in fact, was approaching 600%. Mr. Speaker, by the time we demitted office in 2015, that ratio had declined to under 40%, had declined to 36%. We did so, sir, by careful and conscious management of public money, by ensuring prudent borrowing and careful investment of the proceeds of our borrowing to assure that the economy would grow in a manner that would ensure that our level of borrowing would be consistent with sustainability. Meaning, in other words, that we would be in a position where we were borrowing at a level that is affordable. That is what we achieved, sir, the last time we were in office. Having inherited a country in a state of complete and total bankruptcy and restoring it to a state of solvency. At the time we came into office, sir, Guyana was not creditworthy. Very few partners or institutions were willing to lend us. By the time we left office, sir, that situation had changed completely. We were once again a creditworthy country. Mr. Speaker, in 1994, when the domestic debt ceiling was last set, it was set at $150 billion. That amounted, sir, to 198, 199% of GDP. That was the level of debt we had inherited, and that was the level at which the ceiling needed to be set in order to accommodate the inherited debt and to accommodate the financing required to repair the damage that had been done to the economy. The ceiling at that time for domestic debt, the ceiling of $150 billion, sir, for domestic debt was the equivalent of 199%, you can say 200% of GDP. Mr. Speaker, we are proposing now a domestic debt ceiling of $500 billion. And I hasten to point out that that represents just 53% of our GDP, compared, like I said, to 198% of GDP, the last 199% of GDP, the last time the ceiling was set. Today, sir, we are proposing to set the ceiling at just about 53 to be precise, 53% of GDP. And I emphasize that's non-oil GDP. That gives you, sir, a sense of how seriously we take our responsibilities with ensuring that we cap the level of debt that we're contracting at a level that will remain affordable. Similarly, sir, as it relates to our external debt ceiling, this ceiling was last set in 1991 by our then predecessors in office. And it was set at a level that was needed to accommodate the staggering and unsustainable level of debt that they had contracted by 1991. And that level, sir, at that time was $400 billion. I might add, sir, that $400 billion amounted to the equivalent of 584% of GDP. That was the level of the external debt ceiling that was set in 1991. We are proposing today, sir, to set the ceiling at $650 billion. It would interest this Honorable House to know that that represents less than 30%, in fact, a mere 29.9% of GDP, and I hasten to add, of non-oil GDP. Contrast, sir, that in 1991, the debt ceiling was set at 584% of GDP. Today, we are proposing to set the debt ceiling, the external debt ceiling, at less than 30% of GDP. Very conservative, reflecting the seriousness, like I said earlier, with which we take issues related to debt sustainability. It is particularly interesting, sir, not only to look at the level of the ceiling relative to the size of the economy. We all, in our own homes, at one time or another, we've contracted debt. And of course, in assessing debt, we might wish to consider how much debt we're contracting relative to how much wealth we have. But we might also wish to compare how much debt we're contracting relative to how much income we are earning. And so, if I may, sir, in addition to the striking comparison of where our proposed debt ceilings are relative to the size of the economy, I would wish also, sir, to share some numbers as they relate to the level of the proposed debt ceiling relative to the level of government revenue. Because that gives you an idea. If you were to contract all of this debt, it gives you an idea of how many years of government revenue it would take to pay off all of that debt, were you to contract all of that debt. And of course, these are ceilings that we're prescribing. They are not amounts of debt that we're contracting immediately. They are ceilings that we're contracting to accommodate future borrowing. Let us examine for a moment the domestic debt ceiling. Mr. Speaker, in 1994, when the debt ceiling was set at $150 billion, it comprised more than 6 times the total revenue, 6.34 times the total annual revenue of the state of Guyana. Mr. Speaker, the proposed debt ceiling of $500 billion that we are now moving to introduce represents a mere 2.19% of government revenue, of government current revenue today. Compare and contrast, sir, that in 1994, had the ceiling been fully utilized, it would have taken a full 6 years of government revenue doing nothing else. It would have taken a full 6 years to discharge that obligation. Today, if the entire ceiling were to be utilized, sir, it would take just over 2 years to discharge that obligation. Similarly, sir, an even more striking comparison is to be had when one looks at external debt. In 1991, when the external debt ceiling was last revised and set at $400 billion, that ceiling, sir, amounted to 33.83 times government revenue. Meaning, and indeed that ceiling was almost fully utilized. You recall, in fact, how much debt had been accumulated by 1991. Meaning that it would have taken 33 years of government current revenue, devoting all of government current revenue to pay off debt in order to pay off that level of indebtedness. 33 years. Sir, the proposed external debt ceiling of $650 billion we've brought now before this Honorable House represents a mere 2.85 times government current revenue. Consider for a moment that comparison. 2.85 times compared with 33.83 in 1990. And so, Mr. Speaker, I've taken this time to elaborate on this matter, really to make the point that these adjustments, notwithstanding that they are necessitated, that they are made necessary to address the tremendous level of indebtedness that we have assumed, and notwithstanding that we have ambitious plans for development, these ceilings have been set at an extremely prudent and responsible level. And I wish, sir, to emphasize that. Suffice it to say that this People's Progressive Party civic government remains enduringly proud of our outstanding track record in repairing the economy the last time we were in office. We remain enduringly proud of the fact that we came into government to meet a state in bankruptcy and restored it to a state of creditworthiness and credibility. That's correct. We stand by that track record, sir, and we guard it very protectively and very jealously. We assure this Honorable House that the new debt ceilings are in fact very prudent. They are in fact very prudent. They assure that we will be able to make the investments that are needed to realize the levels of growth to which we aspire, to repair this deep and scarring damage that was done to the economy, and to ensure that we can return to a trajectory of positive economic growth and improvement in the well-being of all of the people of Guyana. Against that background, sir, it is my privilege to commend both of these orders I will, if necessary, speak on the second one at the appropriate time. That is to say, the External Loans Act. I trust, sir, depending on how the debate goes, that it will not be necessary to repeat any of these arguments. But I move now, and I commend to this House, firstly, the Public Loan Increasing of Limit Order 2021. And I hope that our friends on the opposite side of the House will recognize and take responsibility for the damage that they've done and for the level of indebtedness they've left. For the level of indebtedness that they have left, take responsibility and support this order to facilitate the damage that they did to this economy. With those words, sir, I commend the order to the House and will, at the appropriate time, move the motion formally for its adoption. Thank you very much, sir.